Hey guys, so the popular D2C eyewear brand Warby Parker have listed with the SEC for a direct listing. Now let's take a look at the company and what they filed in their S1. So the company is Warby Parker and they operate a bricks and clicks model. So what they mean by that is they have a bunch of retail stores which deliver prescriptions, eye examinations and glasses, and they also have an online e-commerce model as well to support that. They started with the e-commerce and then they went into the bricks, which is quite interesting. Now, I'm heavily involved and invested in the optical space, so this is something I know quite well, and we've been keeping an eye on Warby Parker for a long time since they started, really. So we've known about their movements, and it's interesting to see they're going for a DPO instead of an IPO, which we'll touch upon later. But let's have a flick through kind of some of the headlines in their S1. So for the years, and before we just get into this, actually, last year they carried out a funding round where they raised $245 million at a valuation of $3 billion. So it'll be interesting to see where do they come in. The market's not super excited about D2C brands. You remember Casper. They traded, I remember, at an IPO of about $12, $13, but then they were trading at $5. So it's not a popular one on the street, but let's see how this one does. Maybe that's one of the reasons why they opted for a DPO instead of an IPO. But let's look at the figures. So this is what they announced in their S1. They said for the years ended 2018, 2019, 2020, they had revenue starting with 272 million, grew to 370, and then you can see it kind of really slows down here. For something that's a bit of a fast-growing company, so to speak, it really slows down to about 6-7% growth in 2020, which is a bit worrying, particularly in the backdrop of COVID, where a lot of other optical businesses did perform quite strongly. And Warby Parker themselves said their e-commerce unit grew very quickly during COVID. So we have to dig deeper into that. Their gross profits have been about the same, 60%. We know this doesn't fluctuate much in the eye care space, but you'd probably expect a little bit better there, given other businesses in the industry. Generated net loss. They lost 22 million in 2018. They broke even in 2019 and then back into a loss for 2020. Whether that's COVID induced, yet to know. But if they remain in another loss in 21, this is going to be a bit of a problem because they were just breaking even. You expect them to then tend up. They've raised a lot of funds, but they've been struggling there. Looking at EBITDA, you're seeing the same story here on EBITDA. 8.6 million, a good breakthrough month, 21.9 million of EBITDA, year in 2019, and then 7.7. We need to figure out how much of this was COVID induced and can they start building that back up. Let's carry on. Now, for the 6 months ending 2020 and 2021, so you can see in H1 2020, they did 176 million revenue, and that's grown to 270. Good sign, okay? And if you look at their gross profit, it stayed similar, 58 to 60%. And if you look at their net loss, 10 million last year, and again, they're still trading a loss, 7 million, but they have tightened that a little bit. EBITDA, though, has significantly grown from 1.2 million to 20 million in 2021. We'll have to look into this because that's a massive uptick and far better than what they would. 20 million in the first half is better than they did in their best year there. So this is something to look into on an EBITDA level. But again, these wouldn't be audited, so it'd be difficult to compare. Now, let's look at some of their key performance metrics. They measure something which is called an active customer. Now, an active customer is somebody who's purchased within the last 12 months, they define. They define those as an active customer, and they're available to purchase again. Now, they have store counts have grown year on year. You can see they had 88 stores in 2018. Like I said, they started off as an e-commerce model, but they noticed that wasn't working well. So they kind of gone for this hybrid and started opening stores and driving the store traffic to e-commerce and e-commerce back to the stores to create that 360 experience, which is very smart. But also, you got to remember the risks is all the incumbent retail players, the big players from Essilor to Luxottica, these guys are already heavy in the retail space and they can very easily set up a digital offering if Warby Parker's isn't robust enough and if they don't have the head start. And that's what we'd have to determine. How much of a head start do they have if we want to invest? So they've gone from 88 stores to 120 stores. And then they did another 7 stores between 2018 2019, and 2020 they did 20 stores. Okay, so steady, decent growth of store openings, but given the amount of funds they raised, you probably want to see that grow a bit more exponentially. Active customers have gone from 1.45 to 1.78 to 1.81, and then 2 million. Okay, so that's growing. It's trending the right way. Again, not hyper growth by any imagination. But for the size of company, I guess they've been around for a decent amount of time. Maybe investors could be excited by that. Let's look at the market. Like I said, I'm quite familiar and au fait with the market. And Warby Parker have included some metrics here in their S1. They're saying the US eyewear market in 2020 was 35 billion, the glasses market was 21 billion, and the global market is 140 billion. So they're saying, look, there's plenty to go at. They're saying the eyewear is resilient despite economic cycles. They're saying it's resilient, but then the numbers don't show that with COVID. So we have to look at that. They're also saying most people need vision correction. They're saying 200 million or 76% of adults in the United States were using some sort of vision correction. They think that's going to keep going higher because more people are using their screens, working from home, etc., etc. They also see an acceleration in the e-commerce business. They say currently it sits at 5% in 2019 and 8% of sales in 2020. They see that trending up, and they feel they're better positioned than the retail incumbents to pick up that the new type of customer that wants to shop online. That's something to research. And also saying there's an increased prominence of telehealth. We've seen Teladoc do pretty well. They're saying that more people are switching to telehealth and expected to surpass 16 billion as a telehealth industry. But how much of that do Warby Parker have to go after? That's what we'll have to figure out. So then moving on, we have some of the risk factors. They listed a whole bunch of risk factors, but I just kept a couple here to kind of give you an idea of the things we need to worry about if you were to invest in Warby Parker. They said, look, we've grown rapidly. We don't have experience at this current scale. I think we'd have to look at the management team to see if they have experience. What companies have they taken their senior managers from? That's what we'd want to dig deeper into the S1 to find out. It's a 235-page S1, so it'll take some time to get through. They're saying if there's any increasing cost in the components, they're highly susceptible to that. We know there's been a lot of supply chain issues during COVID and now the Delta variant. What impact could that have on them? They're saying the optical industry is highly competitive. Yes, indeed, it is very competitive. And the difference is Warby Parker they're a disruptor. They're not an incumbent optical player. So how will they fare in terms of regulations? Any state or Fed-wide changes to policies and regulations could have a big impact on them. The other thing they got to rely on is increasing to maintain their brand. What's got them to this point is the brand and notoriety they've been able to build. But once that excitement around a brand kind of dissipates, what happens there? You've seen them raising rounds and kind of going around the investor community and getting some PR. But at one point, do they become really, truly visible on the ground that people are talking about Warby Parker and getting that true unaided brand awareness? So let's flick on to the consolidated statements that they shared. So you can see in 2021, they're pointing us to a 270 million figure for the first half of 2021, which is considerably up from the first half of 2020, but we know some of that was impacted by COVID. But interestingly, is what I wanted to point out was the growth year on year. So you can see 270, they grew out to 370, and then they stagnated to 390 million. Which is interesting. And if we look at the loss, we're seeing a 20 million loss here in the first half, which is something we'd have to dig into here, is this net loss per share attributable to common stockholders. We'd have to look into this 20 million because it was only 10 million in the previous half. So these are kind of the very initial headline things that I'd want to look at. Moving on to some of their KPIs. You can see that they've grown their active customers. We spoke about this, 1.45 to 1.78 to 1.81, sitting at 2.08, they're saying, in the first 6 months of this year. So we wanted to monitor that. We've seen the store count go up, and we've seen their adjusted EBITDA go up. Again, something we want to look at. Now, 7.4% EBITDA margin for a retail store probably isn't the best in the optical space. So something else for us to look at as well. Okay, so now let's quickly look at their mix between e-commerce and retail. That's one of the things I'd want to understand is what is the key to their business? Where's the revenue coming from? And what they're suggesting is it's not a simple story. So in 2018, and I'd want to go further back than this as well, because from my memory, it was all e-commerce initially, then they brought in retail, and at that point, what contributed what? But from 2018, we can see 62% came from retail and 38% came from e-commerce. And that then dropped, so the e-commerce got weaker in 2019 when you would have expected they got progressively better. They're saying that's due to them buying a lot of stores, okay. But then in 2020, due to the pandemic, everybody then went to purchase online, so they benefited from that to 60% mix. But we're not seeing that really in the figures. We're not seeing massive growth in 2020, which is what I don't understand. So what they're almost saying is people transitioned, their existing customers transitioned to online, which is why the mix changed to 60% e-commerce, but they didn't grow more through the funnel. They didn't really gather so many more customers. So we want to dig into that a little bit more. And then finally, we want to understand, okay, what is the product mix? So they're saying 95% of the products they sell are glasses and 5% contact exams and accessories. Now, this is not very well diversified for Warby Parker. And this just highlights the fact that they're a direct-to-consumer brand. They're not an eye care provider. In the type of businesses that I've been involved in and I'm invested in are true eye care providers, in that a greater proportion will be made up from the clinical aspect of the business. And that clinical aspect of the business is the moat that will protect those businesses, because that's the barrier to entry for anybody to just come in. Because at this point, they're bringing only 5% from the exams. They're basically just carrying them as loss leaders almost. They're not doing much in contact lenses or accessories. And it's just people coming in, knowing the brand and wanting the brand glasses. So they're no different to a t-shirt company, no different to Nike or Under Armour in that sense, that it's just a direct-to-consumer brand. And they're not really benefiting from the clinical repeat purchase cycles that you get in a traditional eye care business. So what impact would that have on their repeat business? We'd have to kind of look at. So there you go, guys. A quick, brief pit stop through the S1. It's a 235-page document, so I'm going to spend more time looking into it. Like I said, I'm really interested in the eye care space. I've known about Warby Parker for a long time, but I've always felt there's a lot of hype. And I'm not sure what the market thinks about it, whether people are looking to enter another D2C brand. It's something we're going to have to spend some time looking at. It'll be interesting to see. I mean, they obviously opted for a DPO as well, so they're not trying to raise funds from this per se. And the difference between, I'll make a separate video if you guys are interested. Comment below if you want to know the difference between a DPO and IPO. But in essence, they're not going to do a roadshow with a bank. They won't have to pay the fees for these extortionate investment banks to go to their investor friends and say, do you want to buy some shares? But they also won't raise any funds. So they won't, not raising any new funds, but they don't need to. They raised plenty. They raised 245 million last year, valuing the company at 3 billion, which we spoke about. But the one thing it does mean, and we saw this with, who do we see this with? Coinbase had a DPO. We saw this with Coinbase, that it means existing shareholders, those that got in at seed rounds, and these guys who got in at the $3 billion valuation, they can dump their shares without any delay. So normally you have a lockout period for an IPO of 6 months where employees and any other shareholders can't get out, apart from the investor banks. But now with a DPO, anybody can exit as soon as the shares start trading. That's how you're creating the liquidity. You're buying off of the existing shareholders. Okay, there you go, guys. Warby Parker, ticker symbol they've listed to get is WRBY. If you want another more in-depth video on Warby Parker, comment below. And I'll see you in the next one.